All right, good evening, guys. Ken at Tortoise Capital, the nightly strategy podcast for August 11th, 2021. And let's see what we got here. I classified today as a strong move to the upside. Low volume. It was a little gap up, a bit of a sell off, but then closed strongly. So everything good. So what we have is the RL30 extension continues to move strongly higher. Let me back it off just a little bit. Yeah. PSAR marching up nicely. We've got the RL10 is still in the fall, but it's getting ready to move into the summer. So this will be a summer, fall, summer, and the Kata 2 entry that's in here. There's like an additional Kata 2. There's this Kata 2, which was the re-entry after this exit, and then another one right here, and that's just working. You'll notice the PSAR is pulling away from the Bollinger Band mean here. That distance is getting a little wider each day. It's just marching northward. The RL90 sloping up strong. The Dragon is almost halfway out of the river. That's very favorable, because that means this is not a runaway upside move, but it is just charging forward like a freight train. The 2-period or the 3-period Hull moving average sloping up strongly. Next stop 445. You can see we've got the a 10-day low here is back at 436. You've got the 2.5% sell-off at 433. You've got the belly of the Dragon here at 431. Belly of the RL10 at 436. The 30-day low is way back here, back by the Z3 and the 5% sell off around 422. So this really has made a pretty extraordinary move up here to the top. So we're just continuing to march and enjoying that ride. Next up is the sectors. So we have the S&P here. At a quarter. Emerging markets 0.27. The Russell and the Dow at 0.5 and 0.63, so pretty strong. Tech sold off a little bit at minus 0.17, and then treasuries were basically flat at minus 0.06. So this is looking like the broad U.S. sectors, and leaving tech behind a little bit. That's actually very good for the broad market, as we'll see here. We take a look at the sectors that outperformed the S&P. So it was discretionary and staples, oil, exploration, and agriculture were all better, between 0.3 and 0.4. You have energy, blended commodities, lithium, lumber, Simon Property Group, which is commercial real estate, Mexico, finance, lumber. So that's a real strong and broad array. And then you add in oil, blockchain, materials, wheat and precious metals. I mean, this thing just crushed today. Bitcoin was strong, Ethereum, and the large cap blended crypto crushed today also. And then the individual targets that worked. You get Coinbase at 3.25. John Deere, Alcoa, Devon Energy, PayPal, and TX, the steel company. So very broad-based strength everywhere you look, and that really bodes well. And that's part of the good news of the infrastructure bill that passed. Right? Okay, sectors that underperformed. You got moonshots. Tech was basically flat, along with ARC Innovation. Now you have Brazil. The FANG's down 0.5. XBI is the S&P Biotechs. You have ARC Genomics slightly underperforming them at 1.3. Clean Energy 1.8. Marijuana 2.5 continues to suffer. VIX showing the way up again for tomorrow. And then the underperforming sectors, starting from the worst, or the underperforming targets, I should say. Virgin Galactic down 12.5%. Robinhood minus 5%. Cliff and Squarespace. So Cliff was the only real material that significantly underperformed. Squarespace minus 0.7. Tesla off a fraction, but still above the key price level of 700. So in my view, this is a really strong performance of the broad market. And when you have both the conservative large caps and the speculative small caps outperforming the S&P like we have here, that means there's a couple different demographics that are really loving this U.S. market. You know, it's harder to get more divergence than buying the Dow and buying the Russell 2000. So that's two completely different mindsets. So I really think this is a very positive sign. Hey, just while I'm here, I was doing a volatility study looking at the last 2,000 days. And this is the Z-scores based on a 2,000-day average true range standard deviation, right? So normally when I'm doing my market classification, I'm looking for something a little more sensitive. So I only use a rolling 100-day, and then I compute the Z-score off of that. But I was interested kind of in the long-term volatility. And what we see is that when you use the 2,000-day average and the standard deviation of the last 2,000 days, so that's like 8 years, 9 years. This is the COVID spike, which was a 9 sigma increase in volatility, which then completely eliminated. We're kind of back around long-term normal. So this would be Z1 right here in this space. So we were flirting with long-term quiet just right in those two little spots. But that's just how big that is. But what really struck me was that I realized that the 2008 and 2009 financial crisis, global financial crisis, it's not even on that radar over a 10-year period. And you got to say how many people that are actively trading even remember that. So it fades. If you're a long-time market participant, you have memories of those things. But if you take something like 10 years as being for maybe a novice investor, a new investor thinking back 10 years ago, all they see is one event that was 9 sigma. But long-term capital management and that global financial crisis, not even there. And then the internet bubble, that just briefs like 1929 and the Great Depression, and nobody has really lived through that is actively trading. Like the Robinhood traders, do you think they know any of that? Or is this the only volatility spike they've ever experienced? I think B. It's the only one they ever experienced. And also, while I'm here, let me talk this piece This was some folks had asked me about the live trading workshop. So I've got about 15 live trading workshops where we traded either 4 or 5 days heavily. And we got that all recorded. There's about 1,500 trades in that stack over those 15 different workshops that we've got on camera. And these are the stats of it. There was the best trade in that whole section was 11R. The worst one was 2R. There were a couple here that were minus 2R. And those were on gaps on hybrid trades where we held them overnight. We had 876 winning trades, 221 scratches, 370 losers. So that was about a 60%. And I would just roll those together, a 40% losing rate. And so the winning trades, so that's like 3-to-2 ratio, 60 to 40. And the average payoff is 1 to 0.4. It's like 2.5 to 1. So it's an unfair coin, like 3-to-2. 3 times you win, 2 times you lose. And when you win, you win 1. When you lose a half. So it's basically 2 to 1. That gives you a system quality number of 5 if you use the 100 normalized. Yeah, if you use square root of n, because n is so large, it gives you a system quality number of 19. So that's why I don't use the square root of n. Once I get past a certain point, like I'm not extra confident in that. There's like some upper limit, and 5 is plenty of confidence. So this line here shows the cumulative R, and that's essentially an equity curve, and that's pretty stable. And then this was the histogram. The particular histogram distribution is called a general extreme value. And what you notice is that the scratches and losing trades is the tallest, and then there's a lot of 1, 0 to 1 and 2, but then you have a fat right tail. Smaller ones, but they start to add up. So the mountain is between -1 and +2 is positive expectancy, and then you get the extra bonus of the fat tail. So what I think I'm going to do is put all of those into one giant reference workshop and make that available to the Platinum members. I will also, I think, sell that to as a standalone product, because there's a ton of small lessons that we learned all the way through. And what happened is, over that 10-year period, is the evolution of a lot of these day trading strategies that you see, like max pain range compressions, frogs, collapsing dragons, emerging dragons, that kind of stuff. The RLCO patterns, all of those are reflected. And what I would say is that all of these day trades kind of reflect a standardized strategy of looking to really control risk and be open to the possibility of reward, and then cutting losers fast and not believing in the trade. And some of the techniques are refined, but there was not really, I mean, I would say these are an evolution of trading styles. And what you notice is in the rolling expectancy, slowly getting better, which I think leads to a increased refinement of technique. Like you start seeing more 2R and 2R plus trades out in this end than you do maybe in the middle. So I'll keep you posted on that. I've got all the video files. We used to sell the individual workshops for a couple $1,000s each for people that couldn't attend, and we paired them up with the research weekend. And so I may just make that two separate video bundles. The research weekends are interesting because they are really where a lot of our good ideas came from, and they also show how different people have been adapting our techniques to their own personalized style. And then the extended feedback in the Q&A sessions are really worth their weight in gold. And I think the one that Tony DeQuick did on Frog Champions is just that's just peak research right there. That one's still amazing. So I think in the next month you can expect to see that. I'm going to make both of those available to the Platinum members, but then also sell them as a separate workshop for people that just kind of want the material. So while I was here, I just wanted to cover that. All right, let's go to trades of the day. So this one was from yesterday. So this was Ken H. And he had re-entered the ETHE swing. This is a 30-minute. And he and I both cashed this yesterday. I cashed mine at 30.5. He took the PSAR at 29. And interestingly, we both re-entered an initial day trade position and kept that as a swing piece. And then that paid off like another 6% as it closed above 31 today. So this was yesterday's chart, and he maintained that one. So he got a nice big payoff on that already. So that turned out to be a pretty nice play. And I'm still bullish on ETHE. This was JP Morgan. Let me shrink that down a little bit. This is a series now from Glenn Osborne. And he is our master pipe organ player. Just a marvelous musician. And so what he's got here is a JP Morgan trade frame from 160, kind of on the Z3 breakout, I would say. The supported spring crossing entry would be more like back here at 156, but this is still legit. He's using about a let's see, about a $6 risk, which is about 2% stop, and that thing is starting to work already. He's got the strength and finance pushing that. And that looks pretty good. And then the upside target would be we're looking at the top of the dragon here, so that'd be at about 165, and then the long-term fair value would be like 171-ish. So there's a good $11 reward to the upside for a $2 risk. Good shape. This one is Caterpillar. Bob posted this one in the chat room yesterday also, and Glenn also hit this one today. Bob picked it up on the PSAR flip yesterday. This is also a legit where it's leaving the river and supported spring crossing. It is really, I would also consider it like a pretty much an emerging dragon as it takes out the top of this dragon. And you can see that it's a Z3 pinch and now breaking out, and it's already well in the money. Got about an $8 risk on the swing. Reasonable target first one, 225. And then when that breaks, those 2 days of harsh sell-off can get erased pretty quick. And so I'm really looking for the hump of the dragon as the target. So I'm looking at 240, 245 as the reasonable upside as it recovers that little sell-off. This one is Dow in the basic materials. Same trade, so the industrials are coming online. The first trade would have been, the supported spring crossing here. And then with the PSAR as the stop, you can see that entry around 61, or when it took out this dot -1, so at about, little 61.50-ish, which is where the current stop is. That one would be well in the money already. But this caught a 2. This is like a slow caught a 2, and it takes out the emerging dragon. That looks pretty good. About a $2 risk and $6 upside, so at least 3 to 1. The first test would be up here around 66 when it gets to Z3, but that's very manageable. This one is McDonald's. He's stalking, so he set this up as a like a 1-2-3 entry would be at 236, and he's using as an execution stop 233.70, so that's like 250. So we can easily see $5 of upside. Just takes it to the far side of the river. Top of the dragon's 243, and that's and the PSAR. So that's well beyond 2 to 1. We're really just trading it from edge of the river to the edge of the river, and this actually would set up like a Kata 2 compared to the previous one. And so we got a summer, fall. So about 3 more days, if we get a RLXD around 240, you could start to breathe a sigh of relief. But I think this is one that's that should do pretty well with the infrastructure bill and sort of the economy return to normal. I like that one a lot. This is Luke with some intraday trading. He gets a fractional loss on this collapsing dragon. That's fine. The re-entry could have been a little earlier, but he gets paid well. Fantastic stop and reverse. Now he's getting the stop and reverse closer to the PSAR, and that really pays off big, and only on a single position. The logical place to try the second position would have been at the Z3 breakout here, or crossing the RL270, or that caught at 2, and they all would have paid off extra. But that makes it kind of easy to manage, and you're not losing this little decay. You're not losing off at 2 scoops, and that allows you to be a little more sanguine, a little more relaxed with the Bollinger Band mean trade, and that gives him 3 minus 0.4, so 2.5 days or 2.5 R in Brazil, and then he was practicing here. That would have been 2.9 for the day. So really nice work. This is Glenn with the chevron, and he's setting up this would be a 1, 2, 3, 4, I guess. If he takes this one with a $2 risk, upside target Z3 and the RL270 and the peak of the dragon, so plenty of room to the upside. And chevron should do well as the energy sector recovers. Intel has not yet made its move, so I kind of like this one, that if this breakout works, then it will have had 3 chances to break out, and it hasn't. So if it breaks out on the 4th one, what it really means is it also had 3 days to sell off, and it didn't. So on the 4th day, if it takes off, that feels like some strength. So you get an SSC there with a dollar risk, and it's $2 to the far side of the river in the middle of the dragon. I would be invoking the 2R battle drill there, but if it can break above 56.5, now suddenly you're looking at the previous peak up here around 58. I like Intel, and the tech sector has been lagging, and yet Intel has not been selling off. So I actually think that when the tech sector comes online, Intel should do pretty well. Alcoa, this one is a day trade that was turned into a swing trade. This is Jamie, and I think this was from yesterday, and I didn't get a chance to get to it because of the late soccer match. So this is perfectly played. He gets a nice entry, keeps a piece, and he's holding 2R, and so he locks in the gains here. And then today that Alcoa paid off really well, so that's in great shape. And you can see that in terms of timing it on the daily, he's got like a COTA 2 and really strong, and it's up around 43.87 at the close. And this really has voted to the upside, has cleared all previous resistance, so he's in great shape. And this was his trade on DigitalOcean. So it had great earnings, as he points out. It sold off harshly, so he was waiting for the uptick, and now he was able to kind of play that around 54-ish and picked up this entry in here on a COTA 2 or an SSC. You take your pick what you want to call that. But that's a perfectly timed trade, and he gets a strong move into the close. And this looks like it has every reason to get back to 63.5. So great work there. Nice work from all the guys, really starting to refine the technique. You guys are crushing it. Well done. All right, whoops, I need the wrong one. I need just the fit page. Yeah, there we go. Okay, so now back to shapes, and we will go to the dashboard number 1, and we're still holding on to bullish quiet. To come up on your screen. So bullish quiet, overbought in every dimension, all good. We are finally back onto risk on, where today that just eked into the green, and that's very favorable, and that coincides with the day they just passed a $3.5 trillion boost to infrastructure and Main Street. This is all systems go. And we're not making any more money, except that we are making money. That's what we're making. We're making more cash. And so you've got to be invested just to keep up with inflation. So don't get fooled by the numbers compared to previous ones. That's just what it takes to maintain pace with inflation, to be honest. When we're at all-time highs, you're not going to get any channeling and overreactions. You're seeing industrials, finance in the min pains. I like that McDonald's frame we saw because that was like a 10-day max pain, so there's a lot of room for that to play catch-up. I'm also interested in Brazil, and the energy sector has room to gain as well. In the Dow 30, handful of dojis again today. Great big breakout in Goldman Sachs. Gotta love that. Let me let that come up on your screen. So Caterpillar, Goldman Sachs, Walmart and Walgreens, JP Morgan in the financial segments, and then DuPont and Home Depot. So this is not tech. This is just Main Street doing really well. No other real patterns to choose from. In the ETFs, again, a handful of dojis. Lots of breakouts, especially featuring the Dow with a very strong move today. Even the globals kicked in some gains too, which you'll see when that pops up on your screen. Let me hold on to that. S&P, big gains today. Finance, very strong, so it's not surprising to see Goldman and JP Morgan really doing well. Metals and mining, along with, Alcoa, U.S. Steel, and those doing very well. So you got McDonald's in the value space there, the catch-up trade, and treasuries are marking time. I like Brazil, oil, and real estate. There's that real estate as the defensive play should still be on your radar screen. All good. I love that the S&P is number one in the squeeze. That tells you that just no panic in sight and ready to crush higher. And Apple and Microsoft both did pretty well today. Were better than tech, even though they didn't really gain a lot, but on a relative basis they were pretty good. And I like Intel for the same reason we talked about before. So all good. The broad-based strength in green in both the ETFs and the Dow speaks for itself. It tells you how broadly excellent this market move was today. That's why I consider it so strong. Not so much on the percentage basis, but on the basis of how broadly strong the market was without tech leadership. And when the tech leadership comes on board for the next leg up, this should really do well. All right, that's everything I got for today. We'll get this published and posted. Take good care, and we shall see you tomorrow.